Is the economy more confusing than ever? If this is the way you feel, well, you're not alone. There are so many cross currents these days, it's hard to keep track. Everything from the threat of looming tariffs to a possible recession, AI stocks that were very strong, now not so much, Fed policy, the housing market, cryptos, and so much more. We're going to consider the latest economic readings and show you what they're all saying. So just last week, the Fed's favorite core inflation measure hits 2.6%. Of course, we're talking about the PCE, the personal consumption expenditure. On a year-over-year basis, was released at a level of 2.5%. It's a little bit of a cooling inflation number, and this is not bad news at all. We can see here the core PCE. Now, this is the Fed's favorite gauge. That's now at a level of 2.6%. Core PC, of course, excludes food and fuel, the more volatile components of inflation. This is following last month's reading of 2.9%. So, at least according to this measure, it looks like prices are cooling a little. But what we're going to show you in a moment, this is not so much the case in all categories. In other news, economic growth is slowing. Well, that's not good news. This is from Reuters. U.S. economic growth slowed in the fourth quarter. The loss of momentum appears to have persisted early this quarter amid cold temperatures and concerns that tariffs will hurt spending through higher prices. There's a lot that's been written about the cold weather and how they're attributing the economic slowdown to that. We don't know if that's really the case, though. This is GDP, 2.3%. This is a tick down from last quarter's 3.1%. That's not going in the right direction. Now, there are mixed messages from the housing market, and this is probably the most difficult to understand. Here last week, the S&P CoreLogic Case-Shiller Index, 19th straight record high in December. They said home prices continue to trend upwards in December as the benchmark national index rose for a 23rd consecutive month. Here we can see here, this is a Case-Shiller Home Price Index. That's now at a level of 327. That's the highest high we've seen, well, all time. The S&P Case-Shiller Home Price Index is on a year-over-year basis. It's also ticking higher. That's at 4%. That's the best number we've seen since August of last year. Now, in other housing news, we have pending home sales. Not so good. In January, the Midwest, South, and West experienced a month-over-month losses in transactions, with the most significant drop in the South, and the Northeast saw a modest gain. They said year-over-year contract signings fell in all four regions, with the South seeing the greatest fall-off. They're attributing this to the cold weather. But the cold weather, well, it was colder in the North than it was in the South, but yet the South had the deepest drop. Doesn't really make a lot of sense. In other housing news, U.S. new home sales tumble. By the way, the median house price is the highest since 22. See, the volume of sales is declining, but prices are still going up. Here's new home sales on a year-over-year basis. That's at a negative 1.1%. That's the worst number we've seen in the past 3 months. Now, here's the monthly supply. The monthly supply shows us at the current pace of selling, if we are adding no new homes to the inventory, how many months would it take to sell all existing inventory? That number is at 9. 9 months of inventory. That's a high number. The number usually we consider to be the average, that's around 5. 9's a high number. Now compare that to the existing home sales. That monthly supply is only 3.5. Wait a second. The new home sales has a 9-month inventory, but existing home sales only has 3.5. How do we explain the disparity? Why are there so many more new homes for sale versus existing homes? Well, there's a number of theories. New homes include completed, under construction, and homes not yet started. So that will push the number higher. There's also existing homes in established neighborhoods. New homes sometimes pop up in new areas that are not quite yet desirable. We have delays in construction. That could lead to a backlog of unsold inventory. We also have new homes, which are typically more expensive, harder to sell. But the real question is, are the homeowners now more motivated to sell than the home builders? See, the homeowners, maybe they're feeling the pinch, maybe they're taking losses in the stock market, maybe they're more apt to reduce their offer price to get their house on the market and to get it sold more so than the home builder. Now, the Fed futures, this is good news. The path is much more clear. You see, if we were looking just at the economic numbers, the macros, it's very difficult to determine which way the market's going. Not so much of the Fed futures, though. In yellow, that's the S&P 500. In blue, that's the 425 to 450 level in June. In other words, that's the probability that in June, the Federal Reserve will not cut interest rates. This goes back about a month or so. Take a look at the pattern we're seeing over the past couple of weeks. Regardless of what numbers are released over the past week or so, we've seen a continuous deterioration in the probability the Fed will not cut rates. In other words, very simply, we're moving more towards the probability that the Fed will cut rates in June. As this is occurring, we're seeing the S&P 500 continue to experience a lot of weakness. In other words, the Federal Reserve is more encouraged to cut rates, or at least the market perceives that they will cut rates, when we have soft inflation numbers, like we saw with the PCE, soft growth numbers, like we saw with the GDP, and some of the housing numbers. So when this occurs, it indicates that the economy maybe is not on such solid footing, and that's why we see the strong correlation. Speaking of economic numbers, we have a big week this week. On Wednesday, ADP employment, factory orders, beige book. Those are very big numbers. On Thursday, we have wholesale inventories. And on Friday, that's the big jobs report, including the unemployment rate. So when we take a look at these numbers, consider, of course, the 10-year bond. It's been, quite telling recently, as well as the Fed funds futures. When the numbers released, if you see the 10-year bond yield and the Fed futures tick lower, indicating that they were less likely to keep rates unchanged or moving closer to a rate cut. Well, over the past couple weeks, this has translated into weak stock prices. Please be aware of that, and we'll be sure to update you along the way with any updates with any news that we see. We hope this has been helpful. We look forward to seeing you back soon.